What's going on, guys? It's Brad with the Bottom Line. Today, I want to talk about the differences between a Roth and a traditional IRA and which makes more sense for your current situation and, more importantly, your future. Ultimately, both of these will set you up well off in your future, but depending on where you're at, one is going to be better than the other. So, before we get started, if you would smash that like and subscribe button, I would very much appreciate it. And getting right into things, here's a chart. On the left is the Roth and on the right is the traditional. We'll walk through each of these criteria, look at what's similar, what's different. Starting with contribution limits. For both, it's $6,000 for 2019. That number is $7,000 if you are age 50 or higher. Now, this is prone to change as it did this year from 2018. The amounts used to be $500 less. Going to deadlines for contributions, this is what's cool about IRA accounts. You can actually contribute up until April 15th of the following year. So it's March 1st right now. I could actually contribute to my IRA account for the 2018 year at this point. So when do you pay the taxes? This is the big difference between the two accounts. For a Roth, you're paying those taxes now before contributing, and that means you're getting those tax savings later down the road. For a traditional account, you're paying the taxes later when you take the money out, and that means tax savings now. So why does this matter? Depending on your tax bracket now and where you expect to be in the future, that can present an opportunity for more tax savings. So we will touch more in depth on that in a little bit. Moving on to income limit. For a Roth, contributions get phased out the more money you make, and the same for traditional, deductions get phased out for the more money you make. And at a certain point, you can't contribute to a Roth and you can't deduct anything from a traditional if you make too much money. However, there is something with a Roth. If you make too much money, you can actually put it in a traditional and roll it over to a Roth. That's just called a rollover Roth IRA, but we won't get into too much depth on that. And I will go over the criteria for the income limits a little later in the presentation. Age limit for contributions, none for a Roth. You can contribute to the account until the day you die. For a traditional account, you only have until age 70 and a half to do so. Both accounts have a withdrawal age of 59 and a half. With a Roth, there is something called a 5-year rule. Now, what this means is if you're 58, you put in money, and at age 60, you want to pull it all out. You can't actually pull those earnings out, tax or penalty free, because it wasn't in there for 5 years. So that's all that means by the 5-year rule. Early withdrawal. Now, the Roth has a foot up on the traditional in this category because in a Roth, any contributions can be withdrawn anytime, tax and penalty free. However, the earnings on that money will be subject to a 10% penalty and income taxes. However, with the traditional account, with exceptions, all contributions and earnings are going to be subject to that 10% penalty and income taxes. Now, there are exceptions, for example, first-time home buying, but for the most part, these are the rules when it comes to early withdrawal. Lastly, an RMD, that's a required minimum distribution, so taking money out of the account. For a Roth, you never actually have to pull money out unless you inherit it. And for a traditional account, at age 70 and a half, you will be required to start taking those RMDs. So the main question you want to ask yourself is, do you plan on being in a higher tax bracket, or that taxes in general will be higher when you are in retirement? Now, historically, and the way I believe things are going in the US, tax rates will likely be higher in the future. But the reason this matters is if your current tax rate is higher, you're going to want to go with a traditional account, because down the road when you pay the taxes and you are at a lower tax rate, it will save you more money. However, if you expect to be at a higher tax rate in the future, you would want to pay those lower taxes now. Now, we'll go on the next slide and kind of go over the math behind this so you understand it a little bit better. Assuming an 8% interest rate compounded annually for 30 years, a current tax rate of 20%, and a future tax rate of 30%, If you're putting in $4,800 yearly into your Roth, that's $6,000 less the 20% tax rate, then you are going to end up with $587,260 for retirement. That's money you can pull right out and not pay any federal taxes on. Looking at the traditional, you put in $6,000 yearly, and when you pull that money out at the end, you're taxed at 30%, and that's going to leave you with $513,853. So that is a difference of $73,407. So in this scenario, the Roth is the better choice. Now, say we turn the tables and assume the current tax rate is 30% and the future tax rate is 20%. Now, in this case, we say $4,200 yearly contribution, so $6,000 less the 30% in taxes, and that's going to leave you with $513,853. And for the traditional, if you're putting in $6,000 a year and tax 20% when you pull that money out, that's leaving you with $587,260. So once again, a difference of $73,407. So if you notice, the amounts literally switched when we switched the tax rates. And in this case, the traditional account is better. So you can see you have to figure out where you expect to be in the future in regards to your tax bracket, because that decision will ultimately save you or cost you in the taxes you pay. So some other factors you want to consider: how much money you will be bringing in. For this figure, you would use modified adjusted gross income, which is basically your income less certain specific deductions, and two, if you'll be filing single or jointly. The reason that matters are these two charts here. On the left is the Roth, on the right is the traditional. I'm not going to go into too much depth on these, but if you find your filing status and your modified AGI, you can determine where your contributions or deductions would get phased out or maxed out under each of the accounts. So some important things to consider. First, if you don't reinvest those tax savings from a traditional IRA, you're going to be better off with the Roth. The reason this is because when you get those tax savings now from a traditional account, a lot of people are going to go blow that on other things rather than putting it in a different investment account. So therefore, you're actually saving more in a Roth, and it is acting as a forced savings method relative to a traditional account. If you want to have multiple accounts, you can. However, that same contribution limit applies across all accounts, meaning the sum of all contributions can't be past the $6,000. So if you wanted a traditional and a Roth, you can do that. Or if you wanted multiple traditional or Roths, you can do that as well. A work retirement account will affect your eligibility for deductions in a traditional IRA. So if you have a 401k, you will have to look at how that affects your deductions. And lastly, there are many factors you have to consider when you make this decision: rate of return, time in the market, how likely you are to need that money early. All of these things have to be factored in, as well as it being the US tax code. It's complicated. There's a lot of exceptions and different laws. So I would suggest that you consult a tax professional when you make this decision. So guys, the bottom line, if you expect higher or equal taxes in the future, you're going to want to go with a Roth because you're paying a cheaper tax rate now and taking those tax savings later on down the road. Guys, if you enjoyed the video, please comment below. If you didn't like the video, please comment below. Please smash that like and subscribe button. One thing to know, I am not a licensed investment or tax advisor. All of this is strictly for entertainment. When making this decision, please consult a tax or investment professional. Thanks for tuning in, and I will catch you guys in the next video.